Right now, as we look at the live terminal, Novo Nordisk is trading at exactly 44.57 USD, taking a punishing intraday loss of 3.06 points, which translates to a severe decline of 6.42% on the session. If you are watching the ticker tape, you are witnessing a massive repricing event, one that goes far beyond a simple bad day in the market and speaks to a fundamental fracture in the growth narrative that has sustained this company for the last 3 years. The chart is bleeding red, and the volume is spiking well above average as institutional offloading accelerates, smashing through support levels that many technical analysts assumed would hold. This is not a drill. This is a reality check for the world's most famous weight loss stock. Expectations for Novo Nordisk have been nothing short of mythological. The general consensus, the story you tell yourself when you look at your long-term hold, is that this company is invincible, a juggernaut that essentially solved the obesity crisis and was on an inevitable march toward becoming the most valuable company in Europe, perhaps the world. The belief was that semaglutide, the magic molecule behind Ozempic and Wegovy, was not just a weight loss drug, but a Swiss Army knife of medicine, capable of curing everything from heart disease to addiction and, crucially, Alzheimer's disease. Investors priced this stock for perfection, assuming that every clinical trial would turn into gold. However, the reality hitting the wire today is starkly different and significantly colder. The news driving this massive 6.42% drop is the failure of the highly anticipated EVOKE Phase 3 trials, which were testing oral semaglutide for Alzheimer's disease. The drug failed to meet its primary endpoint of reducing cognitive decline. Reality has just crashed into expectation. Semaglutide is a powerful drug, but it is not a miracle cure for the brain. And that realization is stripping billions of dollars in speculative premium out of the stock price in real time. When we look at who is selling, the picture becomes even more interesting. If you log into your account on the Robinhood app or check the trending tickers on SoFi Invest, you will see a flurry of panic selling from retail investors who are holding this stock purely on the hype of it being a forever compounder. These investors are reacting emotionally to the headline. However, if you look at the order flow coming through interactive brokers' trading platforms, where more sophisticated algorithms and professional traders operate, you see a different kind of selling. This is structural unwinding. The pros aren't selling because they are scared. They are selling because their models have changed. The lottery ticket of an Alzheimer's indication, which analysts at firms like Morgan Stanley had estimated could be worth upwards of $5 billion in annual revenue, has just been torn up. Without that potential revenue stream, the current valuation multiples simply do not make sense, and the smart money is re-rating the stock lower to match this new, harsher reality. It is important to understand the gravity of this specific trial failure. The EVOKE trials were not just a side project, they were central to the thesis that GLP-1 agonists could transcend metabolic disease and treat neurological conditions. The theory was that by reducing inflammation in the brain, semaglutide could slow the progression of Alzheimer's disease. While the data showed some improvement in biomarkers, it did not translate to a statistically significant slowing of the disease itself as measured by the clinical dementia rating. This is a scientific dead end for this specific mechanism in this specific dosage, and it forces investors to look at the core business with fresh, critical eyes. If the blue sky scenario of treating the brain is off the table, we are left with a weight loss company that is facing the most intense competition in pharmaceutical history. This brings us to the elephant in the room, which is the relentless rise of Eli Lilly. While Novo Nordisk is stumbling today, stumbling over trial data and supply constraints, Eli Lilly has been executing with lethal precision. Their drug, tirzepatide, branded as Zepbound and Mounjaro, has shown clinical superiority in weight loss efficacy compared to Wegovy in several studies, and the market knows it. If you were using Schwab Intelligent Portfolios to manage a basket of healthcare stocks, your algorithm would likely be rotating funds out of Novo and into Lilly right now. The divergence between these two giants is widening, Eli Lilly has recently crossed the $1 trillion market cap threshold, leaving Novo Nordisk behind to grapple with its internal issues. This is no longer a monopoly. It is a war, and today's drop suggests that the market believes Novo is losing its defensive moat. Let's take a step back and look at the company itself to understand what is at stake. Novo Nordisk is a Danish pharmaceutical giant with a history stretching back a century, primarily focused on diabetes care. For decades, they were the world's insulin factory, a stable, boring, dividend-paying utility of a stock. That changed with the discovery of GLP-1 receptor agonists. They figured out that by mimicking a hormone that makes you feel full, they could treat obesity effectively. This pivoted the entire business model from managing a chronic disease, diabetes, to solving a lifestyle crisis, obesity. They make money by selling injectable pens and increasingly oral pills that patients must take weekly or daily, likely for the rest of their lives. It is a recurring revenue model that software companies would envy. However, that model relies entirely on two things: keeping the patent protection secure and actually being able to manufacture enough of the drug. The manufacturing issue is the silent killer of the stock's momentum. While the headlines today are about Alzheimer's, the deeper rot in the share price over the last few months has been about supply chains. You cannot sell what you cannot make. Novo Nordisk has struggled to fill the finish capacity for its pens, leading to shortages that have frustrated doctors and patients alike. This opened the door for compounding pharmacies to flood the market with off-brand semaglutide, eating into Novo's market share. While they are trying to fix this by acquiring manufacturing sites, like the massive deal to buy Catalent's facilities, these integrations are messy, slow, and expensive. If you are an individual brokerage client looking at the long term, you have to ask, can they scale fast enough to stop patients from switching to Zepbound, which is becoming more readily available? Furthermore, the management situation has added a layer of uncertainty. The recent leadership shakeup, with new CEO Mike Dustadar taking the helm after the departure of Lars Frugaard Jorgensen, signals a company in turmoil. Dustadar has promised a performance culture and has already initiated significant workforce reductions, cutting nearly 11% of staff according to recent reports to trim the fat. This is the classic behavior of a company trying to defend its margins rather than one that is aggressively growing. When a growth stock starts cutting costs to boost earnings, it is often a signal that the easy growth phase is over. The market hates uncertainty in the C-suite, and right now, Novo Nordisk has plenty of it. We also have to talk about the political landscape, which is tightening like a noose around the pharmaceutical industry. Whether you are listening to news on your Fidelity mobile app or reading reports from investment banks, the chatter about drug pricing is constant. Governments in Europe and the United States are cracking down on the high cost of GLP-1 drugs. In the US, the pressure to lower the list price of Wegovy and Ozempic is immense, with politicians from both sides of the aisle calling the current pricing predatory. Novo Nordisk has already signaled it will lower prices to gain broader coverage from insurance and Medicare, but price cuts mean margin compression. You have to sell a lot more volume to make up for a lower price, and as we discussed, they are already struggling to manufacture the volume they need. It's a catch-22 that is making investors incredibly nervous. Comment below how many shares of Novo Nordisk you currently hold, or if you sold them earlier this year when the stock was trading significantly higher. I want to know if you are treating this drop as a discount or a warning sign. Now, let's navigate into the technical environment for those of you who trade using platforms like Interactive Brokers stock trading tools. The stock has broken through the 200-day moving average and is now testing lows not seen in years. The RSI flashes is oversold, which typically suggests a bounce is due, but in the context of a failed Phase 3 trial, oversold can stay oversold for a long time. This is what we call a falling knife. Catching it requires nerves of steel and a belief that the market has overreacted. If you are looking at Fidelity ETFs that hold healthcare stocks, you will see they are dragging today, specifically because of Novo's heavy weighting. The contagion is real. However, it is not all doom and gloom. We need to look at the future pipeline to see if there is a recovery thesis. The reality is that Novo Nordisk is not a one-trick pony, even if it feels like it today. They are going all in on oral formulations. The holy grail of weight loss is not a shot you take once a week, but a pill you take once a day. The failed Alzheimer's trial was for oral semaglutide, yes, but the weight loss efficacy of oral versions is still robust. They are also developing next-generation drugs like CagriSema, a combination therapy that aims to achieve even higher weight loss, potentially rivaling bariatric surgery. If CagriSema data comes out strong later this year or next, today's drop will look like a massive buying opportunity. The company is also pivoting to other indications, such as heart failure and kidney disease.